Today I'm going to deal about business finance or industrial finance. Business finance means funds and credit employed in the business. Finance is the foundation of business. Finance requirements are to purchase goods, raw materials, assets, and other flow of economic activities. Business finance include those business activities that are concerned with the acquisition and conservation of capital funds in meeting the financial needs and overall objectives of business enterprise. Business is the generation and circulation of products and services for fulfilling the needs of society. Business requires money for successfully doing any operations. Funds are livelihood of the business. Business would not function unless there is adequate money accessible for use. A research of financial needs and options to fulfill those needs must be done with specific end goal to arrive at effective financial management to maintain business. Now, requirement of money or funds for one, fixed capital requirements, that is to beginning a business, money is required to buy fixed assets, land, building, plant, machinery. Second, working capital requirements. Business needs funds for day-to-day activities to buy raw material, salary payment, wages, rent, tax, etc. Third, diversification of company needs. Funds to diversify its activities and multi-product companies, for example, ITC. Fourth, technology upgrading. To adopt latest technology, for example, softwares, computers. What is the importance of business finance? Money is actually a most important tool to bridge gap between production and sales. Some important functions are as follows. Business finance, it required for meeting certain contingencies, unexpected problems may arise. Business finance necessary for the promotion of sales. Money is necessary for some to avail any business opportunities that may present themselves. Some basic concepts of business finance are as follows. The control of company's money and monetary affairs. Second, long-term investment should the firm take on dividend decisions, etc. Financial decisions. The way in which funds have been raised and used in productive activities. Next, general return for the investors. The mix of funding obtained from capital markets. Proportional holding of debt and equity, that is capital structure. Returns are passed on to investors, equity holders, and dividend policy. Next, what are the objectives of business to firm? The main corporate objectives is to maximize the value of the company or maximize shareholders' wealth. Other objective is social, ethical, like responsibility to employees, customers, and society. Maximize share price of the firm. Now, corporate finance is investment, finance, and liquidity. Investment and finance. Planning and managing firms' long-term investments, that is capital budgeting. In capital budgeting, financial manager tries to identify investment opportunities that are worth more of the firm, the cost to acquire, the value of cash flow general by an asset exceeds the cost of the asset. Now, evaluating the size, timing, risk of future cash flows is the essence of capital budgeting. Now, the decisions for Reliance to open another stripe is an important capital budgeting decision. Financing. Cash invested in assets must be matched by the equal amount of cash raised by financing. Capital structure. Mixture of long-term debt and equity maintained, bought, are the ways in which the firm obtains and manages long-term financing. It needs to support long-term investments. Now, financial management consider how to borrow debt and equity, what least expensive sources of funds are, to decide how, where to raise the money. Liquidity. This is third perspective. Availability of cash, having sufficient cash to meet obligations. Now, working capital management. Short-term assets and liabilities. Managing working capital, that is day-to-day activities that ensure the firm has sufficient resources to continue its operations and avoid interruptions. Finance manager decides the terms to offer, means to obtain needed finance, short-term requirements. Now, decision makers are any corporate employees, managers to represent the owner's interests, make decisions on their behalf. They are shareholders who elect board of directors. Board of directors include chairman, chief executive officer, executive director, non-executive director. Now, what are the responsibilities of this board? Maximize value from cash. How? Buy assets that earn more cash than the cost. Choose long-term investment that increase firm's value. Raise cheap external financing. Ensure efficient tax policy. So these are the how to maximize value from cash. Now, corporate finance. Planning, internal audit, tax, business integrity. So these are the major responsibilities of the board. Now, equity. The amount of money raised by the firm that comes from owner's investment. Equity. If you were to invest some money in a business in the form of share, the money put in is called equity. Now, what are the goals of a business? Survive, maximum profit, minimum cost, maximum sales, avoid financial distress and bankruptcy, maintain steady earning growth, beat the competitors. These are the business goals. Now, financial management. It acts in shareholders' interest by making decisions that increase the value of equity, maximize firm value or current value of the assets. Now, what are the financial markets' role and corporation? Financial markets are the fundamental role in operations of large-scale corporations. Stock market will always be important. It can inform management the performance of their competitors, suppliers, customers, and economy as a whole. Primary objective of financial market is to facilitate the flow of money from those surplus to those who need. Now, sources of financing: private investors, bank loans, equity, bonds, tradable, and interest, return of money in the end. Now, short-term finance requirements. What are the primary markets? The original sale of securities by government and corporations, where you initially raised money. That is called first issue bonds. It happens that transaction raises money for the corporation. They are of two types: public offering, private offering. Now, what is the secondary market? Securities are bought and sold after original sale. When you sell a bond to someone, goes to secondary market by transferring ownership in corporate security. Now, dealer versus auction markets. Dealer, who buys and sells for himself at his own risk. Auction market. They have physical location. Most of the buying and selling done by dealer, but auction market is to match those who wish to sell with those who wish to buy. Dealers play a limited role. Business finance. Trading in corporate securities. Most large firms trade in organizational auction markets, that is NASDAQ. Now, listing. Securities that trade on organized exchange are said to be listed on that exchange. To list, the firms must have meet a minimum criteria differ from one to other exchange. Now, corporate governance. It is concerned with own firm manage themselves and the way in which this performance monitored. When shareholders hire professional managers to run company, it is important to ensure that the business decisions are made that maximum the wealth of shareholders. Now, there are three types of business organizations: sole proprietor, partnership, limited corporation. Sole proprietorship, it is owned and managed by a single person and it is very easy to form. Profits are taxed as personal income. It has unlimited liability and life of the company is linked to life of the owner. Fund is limited to his own personal wealth. Now, partnership is easy to form. It requires an agreement and it is unlimited liability of the partner, and partnership is terminated with the agreement and it is very difficult to raise cash. Profit taxed as personal income. It is controlled by partners and voting by major business decisions. Now, limited corporation, it is having articles and memorandum of association, and incorporation is required to form and complicated to form, and limited liability. Profits are taxed at corporate tax rate. Board of directors run the business. Life of the company is hypothetically unlimited. Now, the agency problems control capitalization. Corporation. They are relation between manager and shareholders. There may be conflict of interest between the agent and principal. Now, types of the agency cause. Agency cause, it is the conflict of interest between shareholder and management, which can be direct or indirect. Now, direct cause. Corporate expenditure that benefits the manager at the expense of shareholders. Now, indirect cost. Corporate expenditure to monitor and control manager activities. Now, what are the problems? The possibility of conflict of interest between the shareholder and management of the firm. Manager. Managers act in shareholders' interest. How closely the manager goals aligned with shareholders' goals. Now, managers are replaced by if they do not pursue shareholders' goals. Managerial compensation. Management will frequently have a significant economic influence to increase share value. Managerial compensation lied to company performance at the top. Better performance within the firm will tend to get promoted. Control of firm. Shareholders are powerful. They can control the whole firm. Usually, the complete control rests in the shareholders, who elect board of directors, who in turn hire and fire managers. When working at Apple, shareholders decided that Steve Jobs should be fired, and so he did. Now, shareholders' rights. Do shareholders have a facility to call managers to account? The conceptual structure of corporation assures out their directives. Shareholders control corporation through dividends. Payment by a corporation to shareholders, either made in cash or in kind. Return on capital directly or indirectly contributed to the corporation by shareholders. Now, corporate governance. Investor protects and financial system control mechanism forms corporate governance system. Investors protection. Legal rights of shareholders in a country. A proxy can also vote by mail. Voters are not blocked before annual general meeting. Cumulative voting system, proportional representation, it exists. Now, oppressed minorities mechanism also exists. Preemptive rights also exist. There is minimum percentage to recall an extraordinary shareholders meeting. Now, what is the financial system? Bank-based system. Banks play a major role in facilitating the flow of money between investors with surplus cash, organizations that require funding. Bank activity monitor corporational after involved in long-term strategies decisions. Market-based system. Financial markets take on the role of the main financial intermediary, whether short-term or long-term. Whether short-term to cash on share price on market performance. Now, what is ownership structure? It is also a control mechanism. Ownership structure is the makeup and contribution of shareholdings in the firm. No single investor has a large ownership stake in the firm. Now, type 1 of agency relationship dominate. Agency issues between manager and shareholders. Separation between ownership and control. Exist investment strategies where government formulates banks or main shareholdings in firm. Agency relationship dominates. Ownership structure has a massive impact on corporate objectives, whereas all shareholders wish to maximize the value of their investment. How value is assessed differ according to the individual manager. Controlling shareholder, minority of shareholders or stakeholders who have trust in it. Now, accounting value of a firm. It is a statement of financial position which is shown in the shape of balance sheet or income statement. A statement of financial position, it is a snapshot of the firm. It is the convenient means of organizing and summarizing what a firm owns, its assets, and firm owes its liabilities. And the difference between two is that firm's equity at a given time. So this is all about position. Now, assets, they are shown in left side, liabilities shown on the right side. Assets, they are fixed assets which are having long life, 12 months plus 12 plus months. Current liabilities, they are less than 1 year, that is less than 12 months. Now, non-current assets, they are tangible and intangible. Tangible like truck, computer. Intangible, trademarks and patients. Now, current assets, they are less than 1 year, which are called inventory. Now, trade receivables, bills from the customers. Now, liabilities, trade payables, which are the receivables, the money the firm owes to its suppliers. Now, non-current liabilities, they are the debt not due in coming year. Bond or bond holders, who are the long-term debt creditors. Now, what is owner's equity? Difference between total value of assets and total value of liabilities is the shareholders' equity. Working capital is equal to current assets minus current liabilities. Now, cash flow statement, operating cash flow. Cash flow is the difference between cash in and out. Cash flow is that arise because of the firm's core operations known as operate cash flow activities. Total cash flow from operations is equal to from investing activities and from financing activities. Thank you.